Welcome to this explainer. Today, we're diving straight into an earnings autopsy of Insperity's Q1 2026 financial report. If you've been tracking the professional staffing and HR sector lately, you know this past quarter has been absolutely packed with surprises, shifting strategies, and some pretty major structural adjustments. So we're going right to the source. We're breaking down their earnings calls, investor presentations, and analyst reports to figure out exactly what is going on under the hood. Whether you're an investor watching the HR space or a business owner feeling the pinch of everyday operational costs, these numbers tell a really crucial story. Here is our roadmap for today. We'll start with a Q1 2026 snapshot, move into decoding the financials, then we'll look at the margin recovery plan, how they are navigating healthcare costs, and wrap up with market sentiment and outlook.
All right, let's jump right into Section 1, the Q1 2026 snapshot.
So Insperity is a massive player in HR solutions for small and mid-sized businesses, but their recent Q1 results? Well, they gave investors some seriously mixed signals. Since they basically act as a co-employer, taking on the heavy lifting of HR, payroll, and benefits for smaller companies, their success is completely tied to the health of everyday small businesses. And this quarter, we literally saw a massive tug-of-war between their strategic pricing efforts and some completely unexpected financial headwinds. Let's move into Section 2, decoding the financials, and figure out what actually happened with those top-line numbers. Okay, so the big headline here is that adjusted EPS dropped 17% year over year, landing at $1.31. Now, on the surface, a 17% drop in earnings per share sounds like a massive red flag, right? It makes it seem like profitability is just falling off a cliff. But before we hit the panic button, we need to peel back a layer. We need to see if the core business is actually struggling, or if this is just an accounting anomaly. Because in stark contrast, adjusted EBITDA actually beat expectations. It came in at $103 million, which is a 1% increase over Q1 of last year. And this is where it gets fascinating. EBITDA is usually a much cleaner way to look at day-to-day business performance and operational cash flow. So operationally, they held steady. They even grew a tiny bit. This massive divergence, a plunging EPS but a growing EBITDA, is our first huge clue that something highly unusual happened below the operating line. And here is the real culprit behind that EPS drop: taxes. You see, the vast majority of Insperity's stock compensation vests in the first quarter. But because their stock price took a dip, it severely limited their tax deductions. That spiked their effective tax rate to a whopping 41%. I mean, compare that to the 29% tax rate they had in Q1 of last year. That tax spike alone essentially cannibalized their earnings per share, totally masking the fact that their underlying operational profit was actually doing just fine. Next up is Section 3, the margin recovery plan, which is really the core of their operational strategy right now. This chart brilliantly illustrates their progress. Look at that steep 21% gross profit drop back in Q4 of 2025. That was a serious hit, and it forced management to kick off a highly focused recovery plan. By tweaking their pricing and getting super selective about client retention and new client mix, they vastly improved that deficit. They shrank it from 21% down to just a 3% decrease in a single quarter. That right there proves their pricing levers are absolutely working. However, you know there's no free lunch in business. This recovery definitely came at a cost. You really can't push aggressively for higher margins without sacrificing some volume. By firming up their pricing, they knowingly took a hit to their fall campaign sales. That contributed to a 1% decrease in paid worksite employees and a 7% drop in new client sales. Now, client attrition sat at 11%, which is actually fine. It's totally within their normal 9 to 12% range. But the slower new sales meant their total headcount dipped. They also took a $9 million restructuring charge to realign their workforce. Basically, they're trimming their own expenses to stay lean while they rebuild momentum. Let's pivot to Section 4, navigating healthcare costs, which is a huge factor for those margins. We are finally seeing some relief here. Benefits costs per covered employee only rose 5%, which is a huge improvement compared to the painful 9% spike we saw last year. If you're providing HR solutions, healthcare costs are literally the ultimate wildcard for profitability. So wrestling that growth rate down from 9% to 5% is a massive win for the bottom line. Management pointed out that this was really helped by lower than expected pharmacy claims, plus a favorable runoff of prior claims. A lot of this improvement comes down to their new United Healthcare contract, which is essentially flattening out their earnings pattern. They lowered the pooling limit from $1 million down to $500,000 per member. What that does is cap Insperity's exposure to those catastrophic medical claims. The trade-off is they have to pay higher fixed premiums evenly throughout the year, and the claims reimbursements shift heavily into the later quarters. It's a structural change. It dampens their earnings early in the year, for sure, but it sets them up for potentially much stronger profitability in the back half.
Finally, let's zoom out to our last section, market sentiment and outlook.
Looking ahead to the full year, Insperity is forecasting between $170 and $230 million in EBITDA. They're essentially doing a balancing act here. On one hand, they're dealing with weakening economic sentiment among small businesses, which impacts sales. Basically, clients are hiring less and growing slower. On the other hand, their margin recovery plan is tracking slightly ahead of schedule, and they've successfully locked in those operating expense savings. So they're keeping a solid EBITDA target by making up in pure efficiency what they might be losing in sheer volume. When we look at Wall Street, analysts are completely divided. You've got the bulls banking on long-term HR demand. They're looking at things like the new HR scale rollout and projecting robust growth, hitting $8 billion in revenue by 2029. Then you have the bears. They are super worried about healthcare costs squeezing margins. Plus, the stock was recently removed from dual Russell defensive indices. That index removal alone adds some short-term volatility as quant funds shuffle their holdings. But here's what's actually kind of crazy. Even the most conservative bear estimates are modeling out strong revenue streams of $8.2 billion by 2028. So the debate isn't really about whether Insperity will generate cash. The debate is simply how much of that cash they can protect from rising costs. So I'll leave you with this question to chew on. As Insperity navigates all these shifting tides, will their strategic margin recovery ultimately outpace the relentless pressure of healthcare costs? I mean, they proved this quarter that they can pull the right pricing levers and restructure contracts to protect gross profit. But with the small business economy cooling off a bit, their margin for error is definitely shrinking. It is going to be incredibly fascinating to watch how the back half of this year plays out once those healthcare claims reimbursements start rolling in. Thank you so much for joining me for this explainer, and I hope this deep dive helped bring some real clarity to what was a very complex quarter.